Crypto is a type of digital asset that effectively operates through a blockchain. And this is kind of a technology where everyone can kind of record all of these transactions in real time and verify them, which is a way to kind of verify that these transactions are happening, that this currency does have value, and sort of to prevent fraud and things like that. And certainly crypto has exploded in popularity in the last few years. We've seen Super Bowl ads. We've seen, famous athletes backing crypto. We've seen a ton of jobs come into this brand new industry. But I think what we've also seen is kind of the risks with crypto, the volatility with crypto. After the most recent crypto crash, for example, the Treasury Department told lawmakers that there needs to be a bill to really define cryptocurrency legally, to create legal definitions for cryptocurrency, to actually regulate the industry in a way that is similar to traditional banks, traditional stocks and bonds and other offerings like that. Say you open a stock trading account or something like that. There are a lot of hoops you got to jump through and sort of guidance that you have to look at before you really jump into it, to say, this is really designed to let users know about the risks involved with trading stocks. There's another level if you're trading like stock options or something that are even riskier, to where investors need to know the risks involved with this. And government basically requires these stockbrokers to lay out those risks and to let people know that these risks are real. There's a regulatory regime set up for stocks and bonds to basically protect investors and to protect consumers, and to ensure that the market is healthy and that people know the risks they're getting into, and that, if things go wrong, the average investor is not going to lose everything. Those regulations don't really exist for all these crypto products. There aren't the same regulations that say, if this crypto company goes under, you are insured, you will be okay, you won't lose everything. Part of it, I would say, is about the risks that people are getting into. The other part is ensuring that people have a legal avenue to get some of their money back if everything goes wrong, or to make sure that they have some kind of insurance, some kind of fallback option legally if the crypto market really crashes. There are a lot of people who got into Terra USD, the stable coin, who were told that this is a stable coin. It will not drop below $1 in value for each coin. It then went to 1 cent. Those people have no recourse legally within the law to get their money back. There was no requirements on how you can market these things. With crypto, with digital assets, those protections aren't there. So a lot of times people can get duped into jumping into something that these crypto companies say is secure, but is not quite as safe as some of those other traditional financial instruments. The Loomis-Gillibrand bill is the first major crypto bill we've seen to really regulate the industry. If Congress wants to regulate crypto, they have to do it in a bipartisan manner, and that's typically not something you see at the start of a new Congress. I think one of the pitfalls to actually regulating crypto is going to be lawmakers understanding the issue and having the knowledge and the tools to really put forth a set of regulations that actually protect the consumers, but don't screw up the whole crypto ecosystem.